Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. As we bring in the new month of June, so we essentially end the first quarter earnings season for the US. And as a result, I wanted to bring you a wrap up of exactly the lessons we have learned and what kind of implications we might have for the second quarter and for the rest of the year, both in terms of the S&P 500 and in terms of some of the sectors. So let's get into it. First and foremost, let's look at the breakdown in terms of some of the numbers. We see 97% of the S&P 500 having reported. Generally, the outperformance has come on the earnings side of things, with revenues a little bit more mixed. That's typically the case. But you can see particular weakness in, say, utilities, which is relatively weak on both sides, but in particular on the revenue side of things, similar kind of thing in terms of basic materials, in terms of revenues in particular with the weakness, but 67% outperforming on the earnings side of things. You can see in terms of the areas that we're yet to see reports, it's really a focus on the consumer cyclicals and non-cyclicals, with by and large the rest of the market having already wrapped up. In terms of the S&P 500 earnings growth, how they ended up versus expectations on a year-on-year basis, you can see that communication services and utilities at the top end here, with utilities expected to be the outperformer, but it was actually communication services with the IT side of things really providing that major boost. You can see in terms of the bottom end of things, healthcare was the big surprise because we were expecting to see materials and energy underperform, but we saw weakness in terms of healthcare as well. And then just above that, you can see a few areas of relative strength compared to what was expected. You can see in terms of industrials and consumer staples in particular, both expected to be largely flat in terms of year-on-year earnings growth, but both seeing circa 5% gains at the end of this earnings season. In terms of the expected earnings and for the second quarter, how have they adjusted as a result? Of course, we saw strength on the communication services side of things, and they have improved in terms of expectations. So there's not a feeling that these purchases have been brought forward and therefore we're going to see a lesser number next time around. Instead, it's indicative of further strength going forward. That is the flip side of what is expected for the likes of healthcare, the likes of utilities. Both now have lower expectations compared to what was previously the case. And industrials in particular now expected to shrink on minus 2.6% expected, whereas previously markets are expecting a figure around about 1%. So certainly the big winners here come in terms of the likes of communication services, the likes of energy, both at the top end in terms of earnings growth expected for the second quarter on a year-on-year basis, and both improved from where we were around the back end of March or the beginning of this earnings season. In terms of revenue growth, again, we're looking in terms of who's outperforming. Well, the financials, we saw a strong outperformance here, certainly with expectations of roughly 3% growth. The figure was closer to 7%, as you can see here, so 3.2 up to 7.2%. So a big upgrade in terms of revenues on the financial side of things. At the bottom end of this was a big underperformance in terms of utilities. 7.8% decline came through for the year-on-year revenue number. That was despite an expectation of a 3.3% decline. Materials and energy both again underperforming, but that's not necessarily to say that it's a huge difference from what markets were expecting. Elsewhere, we saw real estate and information technology both outperforming on that front. In terms of the second quarter, how have expectations changed? Again, energy expectations have changed quite significantly, whether that's in relation to the earnings or whether it's in relation to the price of the underlying assets or commodities. That remains to be seen. We've also seen a significant upgrade in terms of utilities, up to 4.6 from 3%. The underperformer here, the one that really stands out, is industrials, expected at 0.5% year-on-year growth for the second quarter. That's down from 4.1%. So significant downgrade there in terms of the industrials. Then in terms of shifts in terms of the second quarter guidance, so how are these businesses looking for looking ahead to the second quarter, well, we've seen by and large a relatively negative shift. You can see that in terms of the top end of this, consumer staples, healthcare materials, industrials, all seeing a relatively downbeat tone coming into play, with real estate the only area where we see a significant outperformance or figure above 50% essentially in terms of those looking at it from a relatively positive light. So this really does highlight some concern within businesses as we move throughout the year that was expected to see central banks really providing a boost for the economy. That hasn't necessarily happened. And we've seen some somewhat jittery economic data coming out recently. Most recently, the US GDP number, which has come off very heavily from the 4.9% that we saw not too long ago. Remember, it's an annualized figure, but nonetheless, we're looking at an area of the market. We're looking at a market that certainly has got significant questions from the CEOs looking ahead to the second quarter. The full year picture is somewhat improved. Let me just flash back to the one before. You can see the differences that we have here. So certainly better. There's more companies with a positive outlook above the 50% mark. Roughly half of the sectors feel positive about the year as a whole. So certainly a little bit more of a upbeat tone for the wider picture as compared to the sort of near-term second quarter. So question marks for the second quarter. And we can see expectations here. Now, we've got earnings per share growth expected at around 10% for Q2, 8% for Q3. But the real growth expected to come at the back end of the year was 17%. Earnings per share growth for the S&P 500 forecast. Now, bear in mind that there is an expectation that towards the back end of the year, we will see inflation starting to come under the control to the extent that we're going to be moving towards greater easing from a monetary policy standpoint. So perhaps that ties in with the view that we're going to see significant earnings per share growth coming into play at the back end of this year. And that should really provide some strength for the underlying assets. In terms of, I'm just going to see if I full screen this, whether it will stop chopping some of these bits. No, it won't necessarily. So what we're looking at here in terms of growth for a handful of names is the demand for goods. So we can see here in terms of sort of consumer staples that we're looking at here, the staples really fall under the Walmarts and the Procter and Gamble's. And then at the back end of it, the likes of Home Depot, Target, Nike, Best Buy starts to move more towards consumer discretionary. And you can see that the strength has been consistent on the staples side of things, and the discretionaries have been underperforming. It's something that I have been highlighting over recent weeks when doing these earnings previews. That really it's the consumer discretionaries that people have been able to cut back on. And certainly as we see the consumer staples increase in price, it takes up a greater degree of people's budget. But people are definitely increasingly cost sensitive and price sensitive. And so, the ability of these consumer staples to keep costs low, keep prices low, does allow them to take greater market share and outperform in this current environment. Services have remained strong, and this highlights why services inflation, essentially the be-all and end-all at the moment, is not down to goods inflation that we're seeing in the US at the moment. We've seen massive outperformance from a couple of names, the likes of Royal Caribbean and Las Vegas Sands Corp. But going forward, there is an expectation that we're going to see continued strong growth for a handful of these names, in particular in sort of double-digit growth for the final 3 quarters of 2024. So really the strength at the moment remains within the services sector, and it's a lot more unpredictable on the goods side of things. But by and large, it really has come down to staples versus discretionaries, and it's staples that have been winning out. In terms of the tech sector, you can see a massive ramp up in spending from the likes of Microsoft, Microsoft, Alphabet, and Amazon, and that comes hand in hand with sales for NVIDIA's data center products. As we can see here, it's moving hand in hand. The expectation is that we're probably going to see continued growth in terms of spending from these big names. But the question mark is this a sort of temporary period where they're going to build out their capabilities and then they're essentially going to really dial back that spending, or is this the new status quo? And that is really going to impact both the costs in terms of these big tech giants, but also the sales and the revenues for Nvidia. So certainly something to be looking out for. In terms of AI, it remains sort of the big focus for markets, and the idea that AI will continue to drive the market as a whole can't just come down to Nvidia earnings, right? And as we move forward, we're going to hope to see businesses coming out with improved margins and greater earnings per share because of their AI investments. We can see here that we've seen a ramp up in terms of, or sort of strong mentions on earnings calls of AI for the obvious areas: information technology, communication services. That, of course, is going to be the case. But you can also see AI referenced in a number of other areas, like real estate, industrials, financials, consumer discretionary. And so the more we see these companies adopting AI, there is a hope that it will result in greater margins and greater profitability down the line. Certainly, this is dominated by some big tech names and some smaller tech names. But you can see here the breakdown on exactly who's mentioning AI in particular within those Q1 earnings calls. And then finally, I wanted to show you sort of the trajectory in terms of the 12-month earnings per share. So the outlook in terms of earnings per share going forward, and the change in the price of the S&P 500. The S&P 500, of course, being the lighter blue line, which has run away somewhat, but the trajectory is upwards for that forward 12-month earnings per share. And that does provide the basis for continuation of the bullish trajectory for the S&P 500. But it's worthwhile bearing in mind that the forward 12-month price to earnings ratio has got over and above the levels seen as an average over the last 5 to 10 years. Excuse me. So essentially what we're looking at in the previous chart highlights why we continue to see the market moving higher, but also there's a question mark here over whether at some point we're going to see it sort of taper back somewhat and easing back as we see relatively stretched valuations for the S&P 500 at the moment. In terms of the S&P 500, let's just look first and foremost at let me just put this in full screen. At the sectors, we can see over the course of the past month that we've seen strength for information technology, but that's been pulling back in towards this weakness that we're seeing at the back end of the month. By and large, that's despite the fact that Nvidia has done particularly well, and that has helped prop things up. But certainly, we're seeing some weakness in terms of the market. And generally, when you're seeing weakness, in particular weakness aligned with economic strength and the potential delays to monetary policy easing, it's likely we're going to see the tech sector really suffering as a result. We've seen a pop in terms of some of these markets at some of these sectors at the same time. So you can see down here some strength in terms of real estate, strength likely in terms of utilities, because that's a bit of a risk-off play. Materials also seeing some strength, and consumer discretionary also seeing a bit of strength, but it comes after a period of weakness. But certainly if we're looking over the course of the past month, the areas of weakness have been consumer discretionary, which, like I said, it's consumer staples that have been outperforming in the good side of things. Energy continuing to weaken, but that is in line with some of the downside we've seen in terms of energy prices. Financials and materials also on the weaker side of things. At the top end, information technology, utilities, although it has been coming off, certainly had a particularly strong first half of the month. And telecommunications also seen a little bit of weakness after a very strong first half of the month. Let's finally end off with the S&P 500 as a whole. I mean, look, this is the chart that you can see here on the weekly time frame, a massive bullish market, and we have been seeing a push up into record highs recently. This bearish engulfing that looks likely to close out for the week does provide us with the basis for potentially further downside. And certainly when we're looking at the breakdown in terms of the price to 12-month forward price to earnings ratio, you can see that perhaps this is overstretched. And so we could see the basis for near-term downside. You can see this sort of topping pattern here, almost a double top formation with the breakdown through your neckline coming with the move through 52.57. So further downside is a distinct possibility over the near term, but the trend is certainly your friend. And the deeper this pullback comes into, the more people are likely to be dipping in. So I'll be looking out for near-term, short-term, intraday bullish reversal setups. You know, people are likely to want to play this to the downside, but we don't necessarily know how deep this is. But in my opinion, this is a retracement before the bulls come back into play once again. So I feel more confident saying this is a retracement and that the bulls will win out for a move back up into record highs than I am telling you exactly where this retracement is going to come back into. But certainly for the time being, given the fact that we've broken the neckline, I wouldn't be surprised to see further weakness over the near term as we move forward and as we exit this earnings season and start to focus more on the economics. Certainly, you know, if we're looking in terms of the if we're looking in terms of earnings season as a whole, you know, it has been largely positive, I would say, but at the same time, we have seen significant question marks coming out. You look at those, the outlook in terms of the earnings per share, and that does point towards some significant jitters from a number of CEOs within the S&P 500. So keep an eye out on the economics as we move forward. I think there's a good chance that we are going to see markets really struggle under the weight of inflation. We're seeing Eurozone inflation moving towards the upside. It's a similar kind of thing that I think we're going to see elsewhere around the world, the likes of the UK, the likes of the US, and that's likely to hinder hopes for a swift move to easing from some of these central banks. ECB likely to be the first, but perhaps the 3 rate cuts that had previously been a distinct possibility could be curtailed somewhat as we move forward and as people start to take in the rise in inflation that we have been seeing. So distinct possibility of some near-term weakness for equity markets, but the trend is your friend, and the trajectory in terms of earnings per share and the projected earnings per share continues to move towards the upside. So that points towards near-term downside as potentially being a buying opportunity down the line.